criticizing it.
Good morning, and thank you for inviting me to your show, Nikunj. Uh, Whether it's excitement, euphoria, the reality is that these are the prices. But having said that, I think some sectors where there is a lot of momentum, news flows, positive news flows, you will tend to see many of the stocks in that segment getting overvalued and maybe discounting 3-4 years forward earnings. And yes, you could possibly say that for some of the stocks that you were mentioning in the course of the conversation. So yeah, I mean the market seems to be in a lot of tailwinds also actually, honestly speaking, after the state election results and now what the US Fed has indicated as far as interest rate trajectory going forward. So these only add to the overall positive momentum which was always there, which is in terms of the domestic GDP growth, IIP numbers, robust inflows from domestic investors, and now hopefully going forward next year we should see very robust FPI inflows, and if I mean and that should lead the large caps which have relatively underperformed versus the small cap, mid caps in the last 1 year. I think a huge catch up rally in the large caps is on the way.
Okay, I'd like to draw your attention to the big pivot by US Fed. Interest rates have peaked out and they will come down. Now, that's a very powerful change for the market. 2021 and 22 and 23, we had to deal with rising interest rates. Now, interest rates, they come down. What will happen because of that?
See, as I said, one is that the whole soft landing of the U.S. economy, that kind of is given if the once the interest rates start correcting, and that should also obviously give an impetus for flows to move out again from the U.S. to other emerging markets, and India could possibly be a prime beneficiary of that. Right. And more than that, I think also if you feel that the US economy is stabilizing or rather there's a soft landing, then the whole economic atmosphere over there, or rather all the IT companies, they should see the positive benefits out of it in terms of all the decision making which was kind of deferred at their end. I think all those things should make a comeback. So from that perspective, if I were to look at it, then good news flows for Indian companies because of the US economy stabilizing or achieving a soft landing and interest rates coming off. Plus valuation multiples. I think falling interest rates will always obviously lift the valuation multiples also.
Sure. So within large caps, given that you are betting on large caps catching up with what the broader markets have done so far this year, what's going to lead that catch up?
So obviously, I think it is the financials and possibly the IT companies. I think they should be the ones which should drive the large caps. And financials have relatively underperformed in the last 12 months, and now they have started catching up. So obviously, that's one segment which should possibly do very well. And IT companies, again, I think they had headwinds in the last 3, 4, 5 quarters, and the stock prices have also reflected that. Now, if they start getting positive news flow, I'm not saying it's going to happen overnight, but maybe in the next 2 quarters, you should possibly start seeing the positive impacts as the US corporates assess the economy and take forward their decision making. So that's one opportunity where in a rising market or in a robust euphoric market, valuations are relatively reasonable. Yes, growth is muted, but if growth makes a comeback, then that's where again investors would like to invest in. And yes, if SPI flows are going to be, they are going to more and more go into large caps. Small mid caps cannot absorb those kind of flows also.
Uh, So I'm just spending a lot of time here, KK, with you because we are trying to understand that, okay, interest rates, they come down, growth stocks, they come back. What is growth? I mean, growth, let's say a couple of years ago, IT was growth. Then defense became growth. When we say that valuations come down and growth stocks go higher, what end of the growth cycle in India, specifically, if you can break it for our viewers, will benefit because of a rate cut cycle?
If you look at the the robustness of the Indian economy and the way your credit growth cycle is. So possibly a 15-20% kind of growth, which is there for the credit, for the banks and the NBFCs. I think that is the segment of growth that you should be looking at. If you look at the consumer companies, FMCG companies, they are struggling. They are struggling at volume growth of 3-4% and below that. So growth for India basically means that the top line growth for for companies that you're looking to invest in has to be 15% plus. And that you can possibly see in auto companies, you can see in cab good companies, you could see in financials. I think those are the segments where you see that kind of robust growth on top line basis, and accordingly your bottom line also grows equally well. So earnings growth have to be plus 15% plus for investors to be interested in. So if you're asking me where is growth, or where investors will investors will obviously invest in these kind of companies where the bottom line at least 15-20% kind of growth and top line can be at least 15%. I think that is the growth segment that one is looking at, and anything below that is not par for the course.
KK,
I don't. Yeah, go ahead.
No, please. You want to finish that point?
No, I don't know whether I answered your question, Nikunj.
Yes. That's what we wanted to understand. Okay, now let's understand the financials. Now, okay, financials are in a great spot. NPA cycles are low. Growth is decent, and there is no challenge whatsoever in terms of any NPA coming near term soon. But this is a template which markets are aware of. This is a sector where positioning is very high. So how does one know whether all the good news in banks is in the price or not?
A good question, Nikunj. I think if you see in the last 12 months, so wherever there was over ownership in the financials, I think those companies, despite the best of fundamentals, were unable to reflect that in the stock price performance. But having said that, some of the tier 2, tier 3 participants, where there was relatively under ownership, those stocks have given phenomenal returns. I think the constraint was the FPI inflows were not so robust, and so you require huge amount of FPI inflows to be able to buy into these top tier banks. So if top tier banks, if you see positive FPI inflows, then top tier banks would again see that buying which is required. So there's nothing wrong in terms of what it's all about, over ownership, under ownership. Similarly, if you see of late, the domestic mutual funds also, the large cap focused mutual funds have also started seeing robust inflows, which will give them the headroom to be able to buy into some of these top tier banks where they are reasonably reasonably owned. But once more inflows are there, they should be able to buy into them more. So I think the maximum returns obviously will be made in the tier 2, tier 3 banks where under ownership is there, where valuations are still very cheap, and reasonable returns will be made in your top tier banks where you could possibly see incremental money being allocated.
Okay. KK, this entire excitement in PSUs, whether it is IRDA or whether it is PFC or REC, how would you rate the entire power ancillary, power financer, that entire space?
So I think this is a multi-year theme, and we have just seen the beginning of it. And I think whether it's in the renewable space, a lot of investments are going to come in, whether it's solar, whether it's wind, etc. We have seen the Dubai announcements also in terms of how they transition from the fossil fuels. So it's a growth is given in this segment. There will be euphoria, right? But financiers, you cannot, and these are specialists who are trained to lend to this segment of the economy. So they will see robust growth in the coming years. I mean, and their ability to raise capital because of their ownership structure again is very strong. Valuations are still very, very reasonable for the growth that these companies can deliver. Dividend yields are still very reasonable. So yes, you are looking from a short-term perspective that the stocks have run up well, but still look at the valuations and look at the growth. My sense is that this segment of the market still has a lot of legrooms and a lot of legs to the rally, at least the financiers. Plus, obviously, all the component suppliers or all the full chain over there will benefit from this. Yes, some of the stocks in may be overpriced or maybe they are discounting 2-3 years in advance. But that's an opportunity. I mean, whenever the stocks correct, that could be an opportunity. But to ignore that segment would not be correct for portfolio investors.
Okay, KK, great to have you on the show. Thank you so much. And in case we don't meet again before the year ends, Happy New Year. See you in